What are mutual funds? A mutual fund is a type of financial vehicle made up of a pool of money collected from many investors to invest in securities like stock, bonds, money market instruments, and other assets. Mutual funds are operated by professional money managers who allocate the fund's asset and attempt to produce capital gains or income for the fund's investors. So, mutual funds, unlike single stocks, usually are a bunch of companies put all together into under one name. So for example, I'll bring up a Vanguard mutual fund. You usually look at what are their holdings. So for example, this is a Vanguard Growth and Income Fund investor shares. It has multiple companies and their top 10 holdings are Microsoft, Apple, Amazon, Johnson & Johnson, Facebook, Google, Verizon, Visa, JP Morgan, MasterCard. Basically, a mutual fund just exposes you to multiple companies under one name, under one fund, under one ticker name, under one ideology or I won't say ideology, but under one thing. And the idea is that you're not exposed to any of it's a good way to hedge your bet. You're not exposed to the high highs of companies, neither are you exposed to the low lows. So if a company is doing really bad, you won't be exposed to those losses. But if a company is doing really well as well, you won't be exposed to those gains as well. It just kind of goes somewhere in the middle. But the thing about mutual funds is it is very, very much managed by professionals. It's a good way, I think, for me personally, if you're opening an IRA or a 401k, mutual funds are a good way to invest those dollars, because it is meticulously looked at every single day by professional investors who sit at a table every single day to look at it and determine what companies are going to be in the fund and what companies are not going to be in the fund. However, the problem with mutual funds is not really a problem, but something you have to watch out for mutual funds is because now you're adding somebody else into the loop, where before you were just buying like Realty Income Corp, or you were just buying Microsoft, or you were just buying a company by yourself. Now you're inviting somebody else into the process, which means you got to pay that person. And so that's where the fees come into the equation. For mutual funds, usually fees are around 1 to 3%. And basically what that means is rather than you having, I'll just show this chart. Rather than you getting all the gains, let's say you invest, like I have a chart on the screen for those who are watching on YouTube. Let's say you invest in $10,000 into a company and you're making 10% gains in 10% gain with the company. However, if you're investing in a mutual fund and the mutual fund has a ratio of about 0.5%, an expense ratio of about 0.5%, in other words, for every 10% gain you make, 0.5% of that 10% is going to go to pay the mutual fund manager and the company or whoever it is. So rather than you seeing the full 10% of the gain, you will only see about 9.5% of that gain. So what does that mean? It means you have to, when it comes to mutual funds, you have to pay attention. You have to pay very, very heavy attention to the gains of that market. You have to pay very, very high attention to the expense ratio. I said gains, I meant expense ratio of whichever mutual fund that you go with. So if it gets to the point where you're looking at a mutual fund and it's around that 2 to 2.5%, maybe trying to find another mutual fund manager. Some great ones that are out there are Vanguard has some good ones. Fidelity has some good ones. There's one that starts with a T. I can't remember what it's called, but they have some good ones as well. Plus, you can also look up online for some fund managers for some financial advisors where you can sit down and have discussions on how you want to go about it. But look at those fees. Those fees are very important. So the way it basically works for a mutual fund is you as the investor, you show up and you say, hey, I have some money. And then the fund manager says, cool, this is our strategy of how we invest that money. They invest the money for you, they generate returns, and then they send that returns back to you. However, they take a percentage of your returns. So you will never see the money being taken out. You will only see the gains that you're making. However, over the long time term, you can lose a lot of money if you don't know how much fees are going into it. And there are all types of mutual funds. You can have mutual funds in bonds. You can have mutual funds in money markets. You can have mutual funds in stocks. There's all types of different types of mutual funds.